Welcome to AML classes. What is bank? A bank is a financial institution that provides various financial services to individuals, businesses, and governments. These services include accepting deposits, granting loans, facilitating transactions, and offering investment and wealth management solutions. Banks play a crucial role in the economy by mobilizing funds from savers and channeling them to borrowers, thus facilitating economic growth and development. There are different types of banks based on their functions and the services they offer. Retail banks, also known as commercial banks, these are the most common type of banks that offer services directly to individuals and small businesses. They provide basic banking services such as savings and checking accounts, personal loans, mortgages, and credit cards. Investment banks primarily deal with large corporations, institutions, and governments. They specialize in providing financial advisory services, underwriting securities issuance, facilitating mergers and acquisitions, and conducting capital raising activities. Central banks are the apex financial institutions of a country's monetary system. Their primary role is to control and regulate the money supply, implement monetary policies, and maintain price stability and economic growth. Credit unions are member-owned financial cooperatives. They function similarly to retail banks, offer a variety of financial services, including checking and savings accounts, loans, and mortgages to their members, but they are not-for-profit entities, and the profits are returned to their members in the form of dividends or reduced fees. Private banks cater to high-net-worth individuals, HNWIs, and provide personalized banking and wealth management services, including investment advisory, estate planning, and tax planning. Cooperative banks are owned and operated by their customers, who are also their members. They focus on providing financial services to specific groups, such as farmers, small businesses, or members of a particular community. What is NBFI? NBFI stands for Non-Banking Financial Institution. These are financial institutions that offer financial services similar to traditional banks but do not hold a banking license. NBFIs play a vital role in providing financial services and filling the gaps where traditional banking may not be accessible or feasible. NBFIs can be divided into two main categories. Depository institutions. These NBFIs accept deposits from the public. They include savings and loan associations, credit unions, and money market funds. Non-depository institutions. These NBFIs do not accept deposits from the public. They include insurance companies, investment banks, and hedge funds. Some common types of NBFIs include insurance companies. These entities provide insurance products, such as life insurance, health insurance, property insurance, and more. Mutual funds pool money from investors to invest in a diversified portfolio of securities like stocks, bonds, and other financial instruments. Pension funds manage and invest contributions from employees and employers to provide retirement benefits to employees. Leasing companies allow businesses and individuals to lease assets like machinery, equipment, vehicles, etc., for a specific period, rather than purchasing them outright. Factoring companies purchase accounts receivables from businesses at a discounted rate, providing immediate cash flow to the businesses. Venture capital and private equity firms. These entities invest in startup companies or private businesses with growth potential in exchange for equity ownership. Microfinance institutions provide financial services, including small loans, to low-income individuals and entrepreneurs who may have limited access to traditional banking. NBFI activities are regulated to varying degrees depending on the country and its financial regulations. They are an essential part of the financial system, contributing to overall economic development and financial inclusion. Thanks for watching.